Okay. Good morning, everyone, and welcome back to our webinar series. Good to see you on our last finale session today. Today we are going to talk about, or we have our second webinar on machine learning. So Danny today is here with us. Good morning, Danny.
Hi, good morning, Celia. Thanks for having me.
And he will talk to us about machine learning principles, specifically in regards to risk management. So we are all looking very forward to your session. Thank you very much. Before we start the session, before I hand over to Danny, I have my usual announcements to make. So please use the chat box if you want to reach out to the Frankfurt School team. If you have any issues with material, links, certificates, technical issues, you can use this chat box. Otherwise, we have a question and answer box for any content related questions. So I'll ask Danny, or Danny himself, he will look at the questions once in a while and try to answer them either during the session if he sees that related maybe to one of the things he just said, or he will also take some time at the end to get back to your questions. And yeah, you will all receive the training material. You will also receive the recording of the sessions. Just hang on till the end of the session, and I will share the link, the attendance sheet link where you can register, leave your information, and then we'll share the material with you. Other than that, some of you might be wondering, what about my certificate? I attended already 15 webinars and my certificate is not here. The certificates will be issued in within the month of February, and we ask you for your patience. I'm already receiving now a question concerning the certificates. Yeah, we will evaluate all the attendance sheets in the next days and see who of you attended 5 webinars, because that's the prerequisite to receive the certificate of participation. You must have attended at least 5 webinars, and then we'll get back to you with the news. Okay. Then you kindly switch to the slide. We can go one slide back, Danny, and then I'll just show everyone again. This is our the program that we have been running now since December. I think a very diverse and interesting program. I think most of you joined a majority of the sessions. If you missed some of the sessions, you can also get in touch with us, and yeah, we see what we can do. Next slide. And here again, as you know, I hope you know that GIZ Egypt is kindly sponsoring packages, consulting packages. So if you or your institution sees a need for technical assistance, technical advice in one of these areas that you now see on the slides, please visit our website, and there you will also find more information on how to apply for these consultancy packages and what they imply in more detail. And the consultancy packages are for free, so it's really a chance in a million for your institution to receive a free 5-day, 4-day advisory by Frankfurt School. Okay, I'm going to send you the link to our website again, and that's it for now from my side. I might come and jump in at the later point again. Thank you, Danny, and the floor is yours.
Thank you, Celia, and thank you to everyone here today for coming. I hope we're going to have an exciting morning. I certainly really enjoy this topic, and I really love machine learning and artificial intelligence. So, so just to let you know what you're in for today, Excuse me. So I'm going to spend 10 minutes just introducing myself and the topic. And then I'm going to be talking a little bit about risk management in general, just because we're going to be talking about machine learning applied to it. I'm also going to be talking about AI and machine learning in general. And then the real heart of today's discussion is going to be on how we can use AI and machine learning to manage risk, because when it comes to machine learning, it's really, even though people have been in this field for a long time, already since the 60s and 70s, it's still really only been adopted more recently. And there are lots of new applications for AI and machine learning in any number of different spaces, and risk management is one of these spaces. So I hope to be able to show how we can use AI and machine learning to manage risk in the classical, well-established area of risk management, even though risk management has been around for a long time. So here we go. So starting off with the introduction, I actually kind of cheat a little bit, and I'm going to be asking you guys to introduce yourself to me first, just so I can get a bit of an idea of the types of backgrounds that I have in the audience today. So the first thing I wanted to get an idea is, given that we're talking about the AI applications of AI to risk management, I wanted to get an idea of how familiar everyone was with AI and how central risk management is to each of you. So I think Celia is going to be helping me with this.
Yeah, let me pull up the first poll. Here we go. So let's wake up everyone this morning. get everyone activated to answer this question. We will wait another 30 seconds to get most of the votes in.
Just while you're doing that, the last answer, which is the highest level of AI, was actually, the idea was given to me because my partner was based in London for a long time, and I attended a lot of meetings. And in those days, simply worked by him putting his phone on the table and putting on the speaker. And it suddenly occurred to one of the people with whom we met regularly that they'd never met me, and there was a chance that if we were super good at AI, that it might actually have just been an AI bot. So I'm glad to see that somebody's in that category. That's very cool. Okay.
Okay, yeah, I think we can. We have our first results already. Let's see.
That's great.
Here, can you see the result, Danny?
Yes, I can. So that's great. So most people know some general concepts. There are a few people who are really good at it, and there are 2 people who are actually not here themselves because they're AI bots replacing them. So that's good to know. Okay, perfect. Thank you.
And stop sharing the results.
And then the
next one. Yeah.
The second question.
And here is the second question.
Wow, there's a clear winner here already.
Okay, you really activated the crowd. The votes are coming in quite quickly. Okay. Oh, interesting. I wasn't expecting this result actually.
Okay, so what we're seeing from here is that for most people, it's a material part of the job, even though they're not mainly risk specialists. And we do have quite a significant group of people, about 1/5 of the crowd here, for whom they really are dedicated risk managers, and that's a central part of their job. So it seems that the majority of people over here have to deal with risk management, at least as a good part of their job, which is great, because I'm hoping that we can I hope that we can cover stuff that will be useful to everyone here today. So thank you very much for your answers. That's definitely going to help me as I go through my talk today. So that's great. So now I'm actually going to do what I said I was going to do. And I'm actually going to introduce myself. So if I can just get, there we go. So let me tell you a little bit about me. So last week or 2 weeks ago at the last seminar, you heard from my partner, Lawrence. If you remember him, he was also South African. I have a little bit of a twist to my story in that I've been in South Africa for a long time, but I actually grew up in Brazil. So I love soccer, really love soccer. And we won't ever talk about that game that happened between Germany and Brazil. But I really love soccer. And just like my partner Lawrence, I studied at the University of the Witwatersrand here in South Africa. But unlike my partner Lawrence, who's an engineer, so I became an actuary. So I spent a lot of time working for insurance companies and banks, and qualified as a fellow of the Institute and Faculty of Actuaries, as well as the Actuarial Society of South Africa. So spent a lot of time studying risk management, but obviously quite focused on financial risk. Um, and I haven't had a real job in a very long time. I've been working for myself now since 2003. But my last real jobs happened to be working for traditional electoral consultancy firms. So I worked for Milliman, the South African branch of it, and I worked for Deloitte for a number of years also as an actuary. And one of the things that I think is worthwhile mentioning is that I suffer from what I call career ADD, which means that I've struggled to focus on one particular career, which is why I'm talking to you about AI today and not actuarial stuff. And in fact, actually, that last logo that you're seeing under consulting and teaching is I spent some time as a professor for the Institute of Advanced Studies in Switzerland. And over there, I was lecturing on finance and risk management, but also in international taxation. So I've really struggled to find a career, which is why when we talk about things that really interest me, AI has been one of the things that totally captured my imagination. When I left traditional actuarial work at the end of 2002, I knew that I needed to do something different, and I struggled to do the same thing over and over. And my ideal type of project was always doing something that I'd never done before, and ideally in as completely as foreign a field as I could do it. And AI was a godsend to me in that it helped me do that, because since then, since 2003, I've been fortunate enough to be able to go into a range of diverse areas. And provided they had data, there was an opportunity for the machine to learn from the data and add value, which has been phenomenal for me. So AI is one of my true loves and passions, and it has allowed me to work in areas like banking and insurance, but also I've gotten to work in all the things that I wanted to study at university but didn't have the opportunity. So today we're using machine learning for engineering, heavy engineering projects. I'm getting to do a lot of medical research with AI, and I wanted to be a doctor, but I pass out for blood tests. I'm too much of a wimp to be a doctor. So AI has been really central to my life for the last 18, 19 years or so. I started Emerge about 10 years ago after practicing on my own for about 10 years, which builds machine learning solutions for a range of different companies. And then one of the things I've been lucky enough to do is work with some of the leading people in the world on the topic of machine learning, and some of that has to do with the EDM Council. I didn't know what it was when I was first asked to join them, but it doesn't stand for electronic dance music. That's the first thing that popped up when I Googled EDM at the time. It actually stands for Enterprise Data Management, and it's an amazing organization that was started about 15 years ago by some very senior data people in the United States. So it was the first chief data officer of Bank of America and Wells Fargo and the Federal Reserve of New York. And they got together and decided that they wanted to set best practice standards for people working in data in the financial services industry. And they've done that, and it's grown. So they now have 7,000 member organizations, which covers pretty much every single major bank and insurance company and regulatory authority from around the world, but also includes heavy industrials, pharmaceuticals, and a range of other different companies. And from 3 years ago, I was lucky enough to be asked by them to lead their work on setting best practice standards for the use of AI and machine learning. So that's been really a privilege, just because they do have some of the world's leading minds as their members. So it's been a phenomenal opportunity to work with these people. And then, as I mentioned in the last column, in terms of my career ADD, as I mentioned, I love doing different things. So besides Start and Emerge and Run and Emerge, or being involved in Emerge, I've also been involved in quite a few other businesses over time. And as you'll see, they're in very different fields. So the bottom one, Broadbridge, is actually not so different. That is our AI-based fund manager. It's a hedge fund, and we use AI to manage people's money, and that's opening up to the public as we speak. Though we've run it for 18 months in private beta, but it's now at the point where we're opening it up to the public. Echo, just above it, is a telecoms company with which I was involved, and the aim behind it was to bring telecommunications to people in Africa. It's a crazy statistic. More than half of people in Africa have never made a phone call just because they live in rural areas, and there hasn't been access to telephony in the rural areas. So the idea behind Echo is that it has the biggest footprint for satellite in the world, and we're hoping to use that to bring telephony and communications and connectivity to people throughout Africa. And Elevated is the most recent one. It's a lifestyle wellness and fitness program where we're trying to get people. It was born out of lockdown where people weren't able to leave. So we're trying to help people develop their businesses, develop themselves, keep themselves well and healthy during lockdown. And that is literally launching today, being the 1st of February. So that's in a nutshell what I do during my day. And but as I mentioned, AI is one of my passions. So I'm hoping to share some of that passion with you today. So that's it about me. So what I'd like to spend some time on, and again, just because I see so many of you work in this field, I don't want to spend too long on it, but I felt it would be remiss of me not to give you just an idea of the overall framework so that you could see the overall risk management framework, just so you could see where we're going to try apply machine learning and AI to it. And so starting off with that, oh, the one thing I thought I should mention to you, and you might have noticed this already, is that by virtue of the fact that I'm an actuary, unfortunately, you're going to have to put up with a lot of bad humor and bad jokes. Dilbert is one of my favorites, but unfortunately for you, I'm going to be making quite a few bad jokes. And the question over here is what exactly is risk management? And risk management has kind of been on people's radar for a long time, and the name implies risk management, but it goes into what is risk and what is management. But what's nice about it is that it's received so much attention of late that, in fact, a whole bunch of new fields have been born out of it. So you might have come across the term enterprise risk management, where instead of managing very specific risks, actually you've got professionals dedicated to the overall risk picture of a business, where the aim over there is to look at the entire risk picture of a business and manage it all together, and see if we're able to make things better for the business overall. And we'll give a more technical definition in a second. But it's gotten so far that, in fact, actually a couple of years ago, the actuarial profession and the engineering profession got together and made a specialist qualification for enterprise risk managers. So you might have heard of the CERA, the Chartered Enterprise Risk Actuary, or there's a CERE, the Chartered Enterprise Risk Management Engineer. But it's become a very much dedicated area of specialty, even though both engineering and actuarial science are areas which are professions which are dedicated to risk management. They occupy a huge part of those professions, but it's become something in which people can specialize directly. And the term that we're talking about over here is when we talk about enterprise risk management. The technical definition given by the Casualty Actuarial Society in the US, it's a discipline by which an organization in any industry, we're no longer talking about insurance companies or banks, it's any organization in any industry goes through these 5 particular activities, where they assess risk, they control risk, they exploit risk, they finance it because risk is going to end up costing some money, and they monitor risk, and they look at all risks from all sources. And the reason they do this is because they want to increase the organization's short-term and long-term value. Now, all of these things would be, I would imagine, would be familiar to anyone just from common sense, except for one. And the one that excites me the most about this is actually this one over here, the third one over here. Actually, there's an opportunity to exploit risk. We often look at risk as things which are bad, that if they come to fruition will actually harm a business. And that is true a lot of the time. But in fact, in many cases, what we're going to see, and I'm hoping I'm going to be able to show through today's discussion, is that in fact, if you manage risk properly, there's an opportunity to not just avoid harm to the business, but actually add value to the business, positively add value, in the sense that we can actually start viewing risks not as just downside volatility, but as actually potential upside to the business if we handle them correctly. And so, and this is something that actually is very exciting, because traditionally risk management has been the type of bubble wrap, very conservative type of person who restricts business activities and generally is seen as a bit of a wet blanket in the business. But in fact, actually, if you do this right, if you're managing risk right, there's a real opportunity to get people excited about it, because it will add so much value to the business and really give businesses a competitive edge, which is one of the things that, again, I'm quite excited about, because if you can do this well, which machine learning helps us do well, there's really an opportunity to prevent harm to the business, but also to add value to the business. So now, in terms of, we mentioned over there, we said that it's the management of any risk to any business. We need to understand what risks we need to consider. And the reality is that there is no universal definition of what constitutes a risk and the, so to speak, dictionary of risks. There are so many different kinds of risks that, in fact, there is no universally agreed even classification of risk. So there are literally hundreds of these things. As you can see from the Dilbert on top, he came to number 36, so there are probably more of them, but there in reality hundreds and hundreds of these things. And so what I'd like to do is actually, just to get the juices flowing, put some of the most common risks on the board, at least on the screen, and then hopefully that will start stirring some of the creative juices, and you can start thinking about what types of risks actually apply in my particular environment, in my particular job. And if there are any of these that you've missed, actually start thinking about those particular risks in more detail. And so, if you take a look over here, we certainly have the most prominent type of risk that we talk about as an actuary is we have financial risk. So these would be things like pricing products correctly. So whether it's insurance products or banking products, or even just general products, whether it's a couch or a good, if you price stuff incorrectly, you could end up not making the profit that you require. Or if you price too high, you could actually end up pricing yourself out of the market. There's currency risk, which is a big thing, especially in companies which have to do business in multiple jurisdictions. This can actually be one of the biggest things. Actually, one of my clients is a big financial institution that does business in 9 different African countries. And their borrowing is all in US dollars, but then they have to use that funding in their different operations in different countries. And for them to be able to repay that debt, they need to make sure that they earn substantially more than the interest they're being charged, because they expected a certain amount of currency devaluation. And so, in fact, we were actually joking that their actual business activity is secondary to their managing their currency risk, because if they do it well, they tend to make money no matter how well or badly their operations do. And if they manage badly, they tend to lose money no matter how well or badly their operations do. Liquidity risk is a big one, where people you might have lots of accounting profit, but you might not actually have enough money to run the business. Inflation is a big one, concentration, whether it's in terms of the types of activities, the types of customers, the types of businesses that you do business with. Credit risk is a big one, especially if you're in financial institutions. Economic risk is one that people might have taken a bit seriously, but until COVID came along, but now that COVID here, the economic risk is something that is apparent to everyone. And by the way, this cuts both ways. For most businesses, the economic fallout from COVID has been disastrous, but there are a few businesses that have actually thrived. Take, for example, business liquidators. They're thriving in this environment because there's so many businesses that have gone into liquidation. So there are lots of businesses that have actually thrived. Even actually one of our clients is a hospital group. Even within the hospital group, there are different types of doctors that have done really well and the different types of doctors that have done poorly. So the lung specialists have all done really well, but pretty much all the other types of doctors have had a significant downturn in their business. Counterparty risk is also an important one. When you rely on some other party to deliver on your plan and they don't, or they might not, these are all things that are a problem. And actually, one of the ones that I want to highlight over here is, in fact, model risk. Since we're going to be talking about machine learning, model risk is a huge area of concern. And as one of my favorite quotes goes, all models are wrong, but some models are valuable. So all of the models that we're going to produce are inaccurate to a greater or lesser degree. The question is, are they still usable? Are they still valuable? And in fact, over here, this is not a subtle risk. One of the greatest explosions in business history was that of a business called LTCM, Long-Term Capital Markets, and it was started originally by the developers of the Black Skull formula for the valuation of derivatives. And so it was actually Black and Skulls who started this, and they at the time were professors at Stanford and at Harvard. They had done really, really well, and they raised several $1 billion to invest in the stock market, and they invested using this Black Skulls formula, and for a while they made a fortune because they were the only ones in the market who really understood how to price derivatives properly. However, there are 6 assumptions that underpin that formula, and one of those assumptions wasn't actually fulfilled when they came to investing in the ruble in Russia, and they lost so much money from their model risk over there by not assessing it properly that in fact not only did LTCM blow up, but in fact they needed a bailout from the US Senate because they threatened to collapse the entire economy. So model risk is not something to be ignored. And then market risk. So you start off selling a product or delivering a service. Do people actually want your service? Are they still interested? These are things that one needs to take into consideration. There's hazard risks. So certainly hazards are things that you have to worry about if you're insuring them, like property damage, but there are also things that you have to worry about even if you're not insuring those properties. So for example, if you were in the business of property ownership and you happen to rent out offices, this is something that you might have not worried about previously, but the fact is that there's much less demand for property these days than there was before COVID struck. Huge parts of major cities have deserted offices. So the returns that people are the returns of people investing in property has been really bad. Natural catastrophes are things we need to worry about. Pandemic is definitely something we need to worry about now, especially since they're talking about how, in fact, a pandemic of the sort we're going through at the moment was inevitable, and we really should have been expecting it for years. And in fact, there's nothing to say that another one won't come along soon. Business interruption is a big one. Longevity is not one that we end up thinking about, but it actually is a concern. Particularly, it's been the topic of numerous conferences in the actuarial profession where we worried about people living too long. And it sounds like a weird thing to be worried about, but it really is a big concern. So when you think about it, from about the 50s and 60s, people used to work until they were about 60 or 65, and then they would retire. And generally, they only had, given life expectancy at the time, they only had a few years left in retirement before they passed away. But these days, people are increasingly living to much older ages. In fact, in Japan, the fastest growing age bracket in percentage terms is the over 100 years old group. And the problem with that is that people are still working until about the age of 60 or 65, sometimes 70. But they're now, instead of having to fund 10 years in retirement, they're now sometimes having to fund 20, 30, and sometimes even 40 years in retirement. And very few people have saved enough for that. And particularly in countries like France, many of the European countries are in this position where the pensions of people, of pensioners at the moment, are paid out of tax income of the current working population. That's a real problem because you've now got a much bigger burden, pension burden falling on the people who are working, and also with lower fertility rates, there are fewer people to pay for this. So it's really creating a lot of strains. Longevity is a big deal. Third type of risk, which I think might actually worth thinking about in your particular context, customer satisfaction. That's a big one, and we're going to be talking about it quite a lot in some of the examples that we bring just now. Um, um, so we're going to be talking about that just now. Fraud is a big one, so especially when money or products are working. So that's going to be an important thing for us to discuss. Product failure, we don't talk about it too much, but actually that is something that can cause tremendous liability. First of all, the product that you spent fortunes developing might not actually work, but it could actually cause harm to people, which in turn leads us to the next one: reputation and brand risk are problems. Ethics is a huge risk people don't discuss at the moment. In fact, I happen to be speaking at a conference in about 8 days' time on ethical risk, which is becoming more and more something that people think about, particularly with the use of AI. Are we using AI in a way that's ethical? We have general ideas of, do we have specific talent in our business that we depend on, which may leave? Compliance is a big one, which we're seeing which we see all the time, and it's been there for a long time, but again, getting more teeth as time goes on. And also increasingly, we're finding that people and businesses are becoming more litigious. So we could end up with internal disputes with our own employees, but we could also end up in litigation with people outside our business. Health and safety is becoming a big one, where especially now when going to work could actually endanger your life through the risk of COVID. And then, does our business actually run correctly? Do we have the right processes, technology? Is our data protected? Are people protected? Data protection is also a huge one. You may remember about 4 years ago, Facebook paying a $5 billion fine because they didn't protect data well enough. British Airways has just paid an £850 million fine for their leak. Equifax in the US, where perhaps the biggest credit bureau in the world, last year, actually now 2 years ago, lost the details of 142 million people. And being a credit bureau, these were not small pieces of information. It was really a relatively complete financial history of people in the United States. So they pretty much leaked the financial history and the financial information of everyone in the United States. And finally, the last type of risk that I'm going to be talking about today, which I'd like us to give some thought to when we think about our own businesses, is how do we deal with strategic risk? So we don't operate in vacuums. What is our competition doing that may affect what we're doing? Social trends are a big one. We saw over here that, if we were to go beam ourselves back 20 years, there was no such thing as widespread use of Google. There was no social media. These are things which have completely changed the way things work and create new opportunities, but can also completely torpedo businesses. And in fact, an amazing thing I've seen how dramatic this is. Not only are things changing, but the speed at which things are changing is faster. So if you went back to the 1920s, the average age of a Fortune 500 company was 67 years old. If you go back 5 years ago, the average age of a Fortune 500 company is 12 years old. So you can see over here that the the rate at which things are changing, the fact that so many new businesses are being catapulted to the forefront of business, and so many of the long, old, well-established businesses have disappeared, that tells you something. And we're going to be talking about a few of these things: capital availability, country risk. These are things that are huge, especially if your business is concentrated in a specific country, and the regulatory environment changes all of a sudden, or we've seen quite a lot of volatility where it makes the doing of business in specific countries overnight become untenable and very difficult. So these are all things that people think about, but I stress this is not at all a comprehensive list of the types of risks that are out there. By the way, Celia mentioned that, and I think I mentioned too, that there's going to be 15 minutes at the end for questions and answers. But if you do have any questions as we go along, please feel free to drop that into the Q&A, to the Q&A section. I've got it on the side of my screen, so I do see them when they pop up. If I don't answer your question right away, it's probably because that's coming up soon in a slide, and I'll get to it in a slide or two. So, but please do feel free to ask some questions as we go along. So, how do we do this? How do we actually manage risk? And in short, actually, we've got a few this part over here actually is relatively well defined. As a risk manager, we have a handful of choices. And these choices, we're going to talk about this in a second, but there's a very well-established process for going through this. And the first thing that you want to do, if you're coming in, if I was parachuted into your job or into the job of the chief risk officer of your business, so I would know very little about your business. And the first thing that I would want to do, knowing that I was responsible for managing risks, would be actually just to collect as much information about the context in which the business operates. So I want to know what type of business you're doing, what are the products that are being sold, what are the services that are being offered, who are they being offered to. I'd like to know as much information as I can about the business. What are the internal controls, what needs to happen, what can break and actually ruin the business. How do customers actually get hold of your service? Who are those customers? Who else do they deal with, and what other products do they buy and consume? What is the financial state of the business? What protection is there already? And so, and what is the regulatory environment like? So you spend a lot of time becoming very familiar with a particular business. And the reality is, this is one of the reasons that chief risk officers tend not to be parachuted into a business where they haven't operated, or an industry where they haven't operated before, because this kind of background knowledge of everything about a specific business is necessary if you want to be able to come up with a comprehensive view of the business and the risks that it's faced. And if you do have someone who ends up being parachuted into that role, what's very important is that that person collaborates and consults widely within the business, just so that he or she actually gets that background and make sure that his eyes or her eyes are open to everything that's happening in the business. Once you've done that and you've had a discussion, it's now time to actually start documenting and listing all of the risks that you think affect the business in material terms. And I stress over here documentation, because many times people are aware of things implicitly, but either that knowledge isn't known by other people in the business, or alternatively, it might be known, but it slips everyone's mind to discuss it. Whereas if you've got on a list, first of all, it's easier for everyone to see what risks you've considered, and they can therefore add in risks if they can see they haven't been considered. And once it's on a piece of paper or on a spreadsheet, it's very easy for you to go through sequentially and actually tick it to say, I've looked at this risk, I've considered this risk, and it's been dealt with. And then the third part over here, which is where things become much more analytical, and this is done to a greater or lesser degree, depending on how formally people want to do this, is you actually want to go through that risk, each one of the risks that you have in your register. And I stress, this risk register could have hundreds and hundreds of particular entries, going down to specific people saying Joe Soap is a real risk because he's our only expert in that particular area, and if he leaves, the business is going to struggle to replace him, and that's a very critical part of the business. So you might actually list specific people on your list of risks, but the point is over here is that you need to start analyzing these risks. And in general, what you're trying to do is come up with two types of probability distributions. One for the likelihood of a particular risk happening or the frequency with which it happens. So you get certain types of risks that happen 5 times a day, and you get others that hopefully never happen, but if they do happen, it's once in 100 years. So you want to come up with some sort of idea of how frequently certain risks happen. And then the other thing you want to take a look at is, what is the impact of a particular risk if it is to happen? And as far as that goes, again, what you tend to find is that most risks that come up tend to be of small value or small impact to the business. There are a few which are a bit bigger, and then you get the really catastrophic kind, which don't happen very often, but the likelihood of these catastrophic risks is very small. So you tend to find that smaller risks happen more frequently and catastrophic risks happen less frequently. So if you look in the insurance context, so little fender benders in parking lots happen much more commonly than complete vehicle write-offs, thank goodness. And then furthermore, cheaper cars tend to be involved in accidents much more frequently than super sports cars. So you see over there that the higher value risks tend to happen less frequently, and also you'll find that people hopefully drive them more conservatively. So you actually want to go through and for each one of the risks come up with a probability distribution, or at least some sort of assessment for how frequently and how severely these risks will actually occur. Once you've done that on an individual basis, a critical part, which is part of this new discipline of enterprise risk management, is this integration of risks. And what I mean by integration is you now have a view of all the risks and how likely they are to happen and what their severity is. But what you don't have yet, and what this step is aiming to address, is can you actually compile a total risk picture? And the reason you want to look at risks in aggregate and altogether is because some of these risks, if you're really lucky, might cancel each other out, whereas some of these risks might amplify each other. So what you want to look at as which risks actually are positively correlated with each other and which ones are negatively correlated. And ideally, what you're looking for is a series of risks which are negatively correlated. So you kind of think of risks as waves. If a trough meets a crest, they'll cancel out. But if two troughs meet each other at the same time, or two crests meet each other, they'll amplify each other. And those are the things that we don't like to see, because then if you have risks that are highly correlated on their own, they might look very small, but because they're all likely to happen together, because they're very correlated with each other, that can actually result in say 20 or 30 on their own small risks, but together become catastrophic. And vice versa, what you might find is that you have risks which look really bad, but because they're negatively correlated with some other thing happening, when that particular risks impacts the business, something positive happens at the same time to cancel it out. So as an example, if you take a look, you might find that a company is a bank that likes to extend home loans to its customers. So what is the effect on, say, a drop in interest rates when that happens? So on the one hand, as a bank offering home loans, that could be good, because if interest rates are low, that means lots of people are actually going to take out home loans, because loans are much more affordable. So on the one hand, that seems like a good thing for the bank. But on the flip side, if you take a look at it, part of the problem over there is that with lower interest rates, the bank's income is less. So those two things go hand in hand together. So it seems like a good thing, but it's cancelled out by a bad thing. Carrying on in terms of looking at the amounts of business, well, because interest rates are low, most people, you might think further that people are more likely to take up the product because it's more affordable, they're going to buy more houses. So that seems like a good thing for the bank, even though their margins are thinner. But on the flip side, because more people are going to take up houses, property prices are going to increase, which again will suppress the take-up of home loans. So it's actually not very clear immediately whether a drop in interest rates or a rise in interest rates is good for a bank offering home loans. The point that I'm making over there is that the bank might identify that it's got all four of these risks: drop in business, drop in margins, or rise in business, rise in margins. And these things are sensitive to an interest rate, an official interest rate set by the central bank. But how it how it impacts the business overall needs to be looked at together, because one particular change in the macro environment could actually affect multiple risks in different ways. And so a key part of this process is actually making sure that we look at risks altogether in aggregate, and we take a look at the types of events which could happen on their own, which we're uncertain about, and how those scenarios are likely to impact the business that we're looking at overall across the entire spectrum of the risks that we've assessed. So that's step 4. When we get to step 5, now that we've got that aggregate view of the company and the risk that it's facing, so you might actually decide that a whole bunch of risks which in stage 3 looked particularly serious aren't so bad, but it could also be that a bunch of risks that you thought weren't too bad are actually quite concerning. And so at step 5, once you've identified the risks which in the aggregate picture are worrying, so then it's time for you to start deciding which ones are the most worrying and their contribution to the total risk of the business, and which ones are less important and can be deprioritized to some extent. And finally, we get to section 6, or step 6 in this process. And there are actually only a limited number of things that you can do with risk. So the one type of way you can deal with risk is by avoiding it. So you can choose not to do that kind of business, or not to deal with that type of customer. So you can avoid it entirely. You can take a kind of subset of that, which is reducing your exposure to that risk. So you might do less of that business. The third way is you can transfer it. So you can either insure it away, which transfers the risk to the insurer, or you can swap risk with someone else. So you might be worried about floating interest rates and somebody else might be worried about high interest rates. So you might engage in, say, a swap where you swap flat rates for floating rates with someone else. And then quite common actually is where there's no particular way to deal with the risk, you might just choose to accept it and finance it. So that case that I mentioned of my client who does business in all those African countries and has to borrow money in US dollars to fund local operations. So they actually ended up having to accept their risk, because even though they were worried about the future currency exchange rates, when they tried to deal with that risk by, say, purchasing forward cover for those particular exchange rates, what they found was that actually in many of the countries there was no forward cover available, there was no counterparty to offer it, and in cases where it was available, it was so expensive that it actually didn't make any sense to them financially. So they just decided to accept the risk, because if they didn't accept the risk, they couldn't do business, and they bet on the fact that doing business will make them more risk, it will make them more money than the downside risk of the currency devaluation which they expected. And the last one, which I mentioned, is if it's possible, can we actually exploit that risk? And it's still kind of the mysterious part of this presentation at the moment, but hopefully when we get to the case studies, we'll actually see some real examples where we're able to exploit the risk. And then the last stage of this process is monitoring and reviewing, because these are very dynamic systems, very complex systems affecting a business, and things change all the time. So there might be new risks that crop up from time to time. It might be that the old risks that you have actually no longer risks for some reason. They've fallen off the radar and you don't need to look at them and consider them at all anymore. It might be that some of the old risks that you were looking at, they happen more or less frequently or have a greater or lesser impact on the business. And it could actually be that the strategies that you adopted in step 6 over here may be working better or worse than you expected, or there might be new strategies that have become available which make more sense for you to try now in the management of your risk. So these are types of things that you need to do certainly on a regular basis. So it makes sense to actually set up these exercises quarterly, half yearly, at the latest yearly, depending on the type of business. And then once that happens, actually to go through this comprehensive process again and review it. And certainly if in between these regular meetings you become aware of a significant change in your risk analysis and your risk management program, it's worthwhile redoing at that point in time also. So this is generally how risks are managed. So, and what I've done over here is that if you take a look at these 7 steps, the areas where AI can play a role is actually in 5 of those 7 steps. It only doesn't play much of a role at the moment in terms of establishing context, because that's something that you as the risk manager need to get involved in and develop an awareness so that you can actually input that to the machine and to the machine learning algorithms. And the last one is actually the conscious decision to monitor and review. But again, because insofar as 7 is actually just redoing steps 1 to 6, actually step 7 itself is actually part of something that you do with AI. But the machine learning algorithm is not going to schedule the regular review or keep an eye out for new particular changes. So it's really up to you to do that. But what we've seen over here is that really in almost all the steps of the risk management process, there's a great opportunity for us to use machine learning, and where hopefully machine learning can add some value. So with that, that's the first part of this particular process. I'm now just going to, again, I stress I don't want to bore you too much, especially since I see there were quite a few people who had an awareness. But what I'd like to do over here is walk you through how AI and machine learning works, just because it's really quite essential for us to get a fuller understanding as to how we can actually make it work in the risk management space. And so what I'm going to do is actually take you through some of the main methodologies, just because machine learning has this kind of mystical mystery around it. And the reality is that we're getting machines to do very simple things repeatedly and at scale. And that actually allows it to recognize patterns, which we wouldn't be able to do otherwise. So that's what I'm going to walk you through over here. I'm actually going to try to do it in less than the 30 minutes I've allocated, just because I'd like to spend more time on stage 4 and some time for questions. So you might have seen this graph 2 weeks ago. And in essence, what we're trying to do with machine learning, even though there are many, many different definitions for it, but it all boils down to finding patterns in data. That's what we're trying to do. So if you take a look at that picture over there, by the way, I'm just doing it illustrated in a picture, but it's actually far less common for there to be pictures involved in the classification, in using machine learning. They're entire dedicated fields to vision and machine learning that deal with images, but most of the practical commercial applications don't involve any images at all. I'm just presenting this in an image because it's easier for us to understand this. But if you take a look at that over there, those red dots, or sorry, the orange dots might be, say, a type of customer who defaults on their loan, and a blue dot might be somebody who doesn't default on their loan. So if we had to distinguish between them, and the way to do that is by drawing a line where we say on one side, if a new loan pops up, we're going to guess orange on one side, and if it pops up on the other side, we're going to guess blue. We might draw a line, something like that, which separates as well as we can between the oranges and the blues, and that would do a decent job. It doesn't do a perfect job. As you can see, there's some blue dots on the orange side and some orange dots on the blue side, but it does a very decent job of being able to classify and distinguish between orange and blue. That's one of the things that we get machine learning to do. And believe it or not, that line was actually drawn by a machine learning algorithm. So without any help at all, the machine did that. And that's probably the type of line that we would have drawn. What you might actually have seen are things like this, where you might have, this is actually a bit of an internal joke in the machine learning space, because in the early days of computer vision, we were training machines to recognize cats in pictures. So if you attended a machine learning conference for about a stretch of 10 years, almost every single paper involved pictures of cats, which is why we're talking about this. So certainly we can get machines to recognize cats and certain types of images. But when you think about it, it's actually quite an achievement, because we look at that in this particular image, there's one cat. But the truth is, it didn't have to be the case. We often have very much busier images where there is a cat in the image, but there are 100 other things in the image. And it might be that in this case over here, the cat's looking directly at the camera, but it doesn't have to be the case. You could have the cat seen from behind, or jumping up a tree, or hiding, partially obscured. This is actually the ideal type of picture for a machine to learn from or to classify, because it's super easy. So we train machines to be able to recognize things in images, specific things in images, even though it's quite a challenge. But what shouldn't be ignored is, in fact, that you can get machines to recognize features in data, even though they might not be so easy to see, just like we can get machines to recognize cats in images that aren't so easy to see. And in fact, we've generalized it to the point where we can get machines to look at that. Now, if you don't know what that is, you're certainly not to blame. This is actually a slide that I got from a pathologist, where she was looking at particular tissue samples taken from people, and then she looks at these slides to determine whether particular masses that they have in their body are cancerous or not. And so you can actually see that the picture's round because this picture was taken literally with a smartphone looking down the eyepiece of a microscope. But while it might not be so important for us to be able to classify cats, since we train the machine to recognize anything, we can get the machine to recognize anything else. And so in this particular case over here, we trained a machine learning algorithm to look at these slides, which takes pathologists years and years of training to be able to do. And now we can get machines to do exactly the same job. And in fact, far faster. The machine with a regular computer can look at 100 images a second. And what's also nice is that you can democratize medicine. You can now get this expertise out to areas where they don't have as many skilled pathologists. And while I'm talking about, again, these things all look very visual, you might want the machine to look at a particular piece of data and determine who in this particular piece of data would be interested in my product, who in this particular database would be bad credit risk or good insurance risk, or is this transaction fraudulent or not? These are all things that we can get the machine to do by training them with data that's specific to the task that we have at hand. And so just as we become better at our jobs over time through having experience, and experience means we've had repeated exposure to a wide range of different types of tasks and phenomena that occur in the course of our life, so too we get machines to do that, except that whereas we learn from repeated exposure, machines learn from databases. And we have way more data today than we've ever had before in history. And that's just exploding and growing faster because people are realizing that we can actually get machines to do stuff using that data and to recognize patterns. And in many cases, it's not our book knowledge that separates us from our peers, that makes us better or worse than our peers. It's actually our pattern recognition. You can have two doctors with exactly the same book knowledge, but one who's better able to recognize diseases and how they present, or better able to recognize what treatments will work. That doctor will be better and more effective than the person who has the same book knowledge but can't recognize those patterns as well. So in essence, all that we're trying to do is get machines to recognize these patterns. So how do we do that? So there are a few different ways. So you might actually have done the most basic type of machine learning, and if you've studied linear regression, that is in fact a machine learning type of algorithm. And in essence, what we're trying to do in a machine learning type of algorithm, which we generalize to many other types of methods. So if you happen to look at this particular picture over there, so this is in 3 dimensions, and the dots are our observations. And the surface is something that we have decided is what we're going to guess if we get a new observation at that particular X, Y, and Z coordinate, or X1, X2, and Y coordinate. And what we do over here is that we measure the error. So the error is in each case the length of the black line connecting the red dot to the surface, and the bigger the line is, the bigger the error. And so obviously one of the ways that we don't like to make big errors, and we'd like our errors to be as small as possible. So one of the most common methodologies used in machine learning is minimizing the total sum of errors. We want the total amount of error to be as little as possible. So we would add up the lengths of all of these lines, and we would adjust that surface so that the surface results in the sum of all of the errors. That's the total length of all those lines be in the smallest. Now, in 3 dimensions, a plane is the equivalent of a straight line, but we could actually make curvy lines like you have in this picture over here, where if you've got curvy surfaces, just like with curvy lines, you can actually minimize the error. And in fact, we get machines to do that. So this actually ends up with a better fit than the flat surface. And that is this methodology of minimizing error, total error, is used in many different families of machine learning. And
Danny?
whereas, yes.
Yeah, I just want to do a quick announcement because we're
Sure.
now we're almost halfway through, and I know that you're going through a lot of content in a very short time, so I just want everyone to know that again we are recording the session. So if you want to come back to any point that Danny mentioned earlier, or you want to repeat what he said, don't worry, you can watch the session again. We normally upload the recording a few hours after the session, once you receive the recording link, in the presentation itself. So as soon as you open the PowerPoint, maybe tomorrow you can open it, and then on the last slide you will see the link to the recording of the session. So don't worry, I know not everyone here is a native speaker, so some of you might be struggling with all the content in this short time, but don't worry, you can go back to every point that Danny mentioned.
Thank you,
Okay,
Celia. Yeah,
thank
thank you,
you.
Celia. So what I'm so as I mentioned, so trying to come up with a surface that reduces the total sum of errors is one of the ways we could do this. However, I'm showing you something in 3 dimensions. Yes, somebody mentioned over here we should minimize the R squared, but we should also reduce overfitting. Absolutely, there is a possibility of making a surface so fit the errors so well that in fact actually it builds into itself random variations and random vicissitudes which you don't want to go throughout your data. That is definitely something to be worried about. But in general, what we're trying to do, the overall approach is say that errors are bad and we want to try and minimize them. There's certainly problems that you can get into if you take that to the nth degree, but absolutely right, you do have to worry about overfitting. So this is one approach. However, what I'm doing over here, I'm showing this to you in 3 dimensions just because we as humans can visualize 3 dimensions because we live in a 3-dimensional universe, but machines are able to do this in 10,000 dimensions. So instead of looking at, say, age, gender, and geographical area as your axes, you might look at 100 other dimensions and the machine can equally minimize the error. And this is one of the general approaches that gets used in a range of machine learning methodologies. Another thing that comes up is that you may have heard of and which has become very popular, which also happens to aim to minimize errors, is neural networks. And the idea behind neural networks, in theory behind it, the theory behind it was that this was meant to mimic how one's brain works. And that is, so you would put in a range of different inputs at the bottom. So we might, for example, want to try project the selling price of a house in a particular area. So we might have in one variable over here, the area under roof, and we might have the number of rooms. We might talk about how many stories it has, how many bathrooms it has, how big its garden is. So we might put all of these things in over here. We might have stuff like how much has a house next door sold for within the last year. So we might put all of these things in together, but the way it's meant to mimic the way a brain works is that in the next layer, we make each of these variables interact with each other. So you'll see over here that whatever goes into that particular node, we might transform it, but then it goes into every single other node in the next layer, and so too over here. So we actually end up being able to combine each of these things in a different way, and then finally they get fed forward into the next layer. This particular network only shows 3 layers, the input, the output, and some middle layer, but the reality is that there could be dozens and dozens of layers in between. And when you hear about things like deep learning, deep learning is just a neural network with lots of these red layers in between. That's what makes it deep learning. That's just called a deep neural network. But in essence, this is what it's doing, and these have become particularly effective for the image and sound classification or image and sound recognition problems that I mentioned, but they have very big application, but they're by far the most popular method in machine learning at the moment, just because they receive the most attention, and some of the fanciest applications of machine learning have been done using neural networks. And then one of the other big and as you see over here, by the way, all the pictures of dots that I show you are exactly the same. And what you're able to see over here is that you can, just as I could use that squiggly line to draw dots, that was done using a method known as nearest neighbors. This particular one over here, this squiggly line has been drawn using neural networks, and it can also draw squiggly lines. This is in 2 dimensions. It can do it in thousands of dimensions. And as you see over here, it does a pretty decent job actually separating between blue and orange dots. There's another type of methodology. Again, when I say over here, these are methodologies, these are families of methodologies. And so there are 1,000,001 different flavors of each of the methodologies that I'm describing. But another methodology, when you think about it, is really, again, a very simple methodology. And we might, for example, this might be house prices again, and this dimension over here might be number of rooms, and this dimension over here might be number of bathrooms for the sake of the argument. So all that this does is it takes a look at the space of things that I've seen before. So let's say in all the houses that I'm looking at to try and learn my pattern, I see that the number of bedrooms ranges from 1 to 8 for the sake of the arguments. That might run from 1 to 8, and number of bathrooms might run from 0 to 5. So that might be on that direction. And then all that it does is that it looks at a way for me to be able to chop this space up, where when I chop it into different areas, so I chop it into area R1, if I've got another house that comes up and I want to guess what its sale price is, all that I would do is I would say, look, if it's got the number of bedrooms, is and number of bathrooms makes it fits into this area. If there's a new thing that comes up, I'm just going to guess the average of all the other houses that look like they fit into block R1, and I'm going to guess that. And so too with R2. If it's got more bedrooms but the same number of bathrooms, I'm going to guess the average number of all the houses that have fit into R2 previously. And that's what I'm going to do over here with all of these different areas. So in essence, all that we're trying to do is saying that things should look more, I'm going to treat things like other things that look similar to them. And that's really all that you're doing over here. You're saying that all houses in R1 look more or less similar, and that they have a small number of bedrooms and a small number of bathrooms. So it's reasonable to assume that they'll sell for a similar price. And houses in R2 have extra bedrooms, but still not so many bathrooms, so they look kind of similar. So I'm going to assume they sell for more or less the same price, and so on. And all that these methods do, they're called tree methods, all that these methods do look at the best way to split this area into other areas, to split the total area, the total square. Can we split them into areas so that I end up, again, minimizing my errors? And they call tree methods. You might not guess why they're called tree methods just by looking at this. But the reason they're called tree methods is because you can actually represent this whole scheme by the middle image, by this image in the middle of the screen, which looks a bit like a tree because you have successive branches. So if you take a look at the top layer of it, it says if x1 is less than t1, which means we're looking at the left. So if x1, that little variable there, is less than t1, then we're looking to the left of that line. Then it says, then go down to this block over here. And then it says, if I'm in that block, then if x2 is less than t2, which means that I'm in the bottom left corner, then I'm going to treat it as block R1. Whereas if x2 is greater than t2, I'm going to treat it as block R2. So you can represent all of these partitionings as a tree, and if you want to, you can even represent them in 3D, and it looks something like that. So all of these three things are mathematically equivalent. But what's amazing about these things, again, it doesn't look like the most complex methodology where I'm just dividing things into areas where things more or less look the same as each other. This particular methodology is incredibly effective in a range of different areas. And in fact, in many data science competitions, it's usually one of the members of this family that ends up winning. So that does really, really well. The last thing that I'm going to talk about, again, they're also quite a big number of families, but I'm only going to be talking about the ones that get used most commonly, are things called support vector machines. And it sounds very complicated, but again, it's quite intuitive. All that this aims to do, if you take a look at the picture, there's some red dots and there's some green dots, and they don't overlap. And all that this tries to do is find a line that I can draw that will separate between the red dots and the green dots, and draw it in such a way so that if I draw that line exactly through the middle of the gap, So there's a gap slightly to the top of it and slightly to the bottom of it, that I can make that gap as big as possible. If I want to separate between green and red, I want to see which road I can I can create between them, or which gap I can create between them that separates them as well as possible. Because if they're very separable, it's very easy for me to work out if a new dot is meant to be green or red, because the gaps don't, the groups of dots don't overlap. And so in principle, that's all this method is trying to do. And obviously it works very nicely if the dots are entirely separable, and there's a methodology for doing that. But in fact, actually, there was a way to make this methodology work out, even if you can't separate the dots entirely. So for example, you'll see that there's a red dot now on the green side, and there's a green dot on the red side. But the fact is that, and there are some in the margin, there are some in this group over here, there are ways to make this particular methodology work. Even though you can't separate them entirely, you're still aiming to make them as separate as possible, even though you can't do a perfect job of separating them. But believe it or not, this summarizes more than 90% of the machine learning methodologies that are in use worldwide. They're all working on these very simple methodologies. So whether we're talking about classifying cats or cancer, or working out who's good or bad credit risk, all that we're doing is using these methodologies. I might be separating between cancer and non-cancer, between red and green, or I might be separating between good credit and bad credit. The same methodology is being applied in all of these circumstances. So these are the methodologies that are being used. Now, the question that we come to, and by the way, you can see over here, is that using these methodologies, you can actually get them to draw squiggly lines too. You'll see over here that if I can only draw one line on the left-hand side, it's going to be straight. But if I can draw squiggly lines, the black line you can see I can make squiggly. So using a combination of support vector machine lines, I can actually, again, separate between blue and orange dots very effectively, and reduce my error, again, subject to the concern about overfitting. But we can get all these methodologies to do pretty much the same type of thing. And the way we choose which one we want to use is often a function of the problem that we're trying to solve and the data that we happen to have available to do it. So but in short, this is really the main types of areas where main types of methodologies that are used in machine learning. And so what I want to do with the time that we have left is to discuss how we can use AI and machine learning to manage risk, and then also put in some best practice recommendations for how this should be done in real life. Because as I mentioned before, moral risk is in fact one of the concerns, and ethical risk is going to be one of the concerns. And these are things that need to be managed, because otherwise we can end up with a situation where the value of the model that we've developed actually ends up being less than the harm that we've caused. So if we take a look over here, so you might remember that stage 2, but the first of the risk management process, where we had those 7 steps, was identifying risk. So can we actually use risk? Can we use machine learning to identify risk? And yes, we can in many cases. So what I'm going to be discussing over here was this particular thing that you're seeing on the screen is what's known as a feature importance table, or it's actually split into 3 just because it would fit on the screen better. But one of the things that we do with machine learning is use the machine learning to identify risks that we might not have thought of. And how we would do this, so you might be wondering, especially if you've got training in statistics or any other type of data management, why is machine learning special? Why do we give it so much attention? And there are a few reasons for it, but one of the main reasons that machine learning does particularly well, first of all, as compared to humans, but also as compared to the other types of, say, MI or BI, say business intelligence, these dashboards which look at big data sets, one of the reasons it does particularly well is that compared to us as humans, or to those things, is that machine learning doesn't have the prejudices that we as humans have. And humans, unfortunately, we have tremendous prejudices and biases, and we often prejudge situations. And our biggest prejudices happen to be that we are biased towards using things that we think ought to explain the feature that we're interested in, and we stay away from features that we think ought to have no predictive power on the thing we're interested in at all. So I'll give you an example in the credit space. So if you've ever been involved in building a credit scorecard, or if you borrow money from a bank, what you'll know is that almost all credit scorecards or almost all credit risk assessment processes try to work out how much they ask you how much income you have, and they also ask you about your existing debt. How much have you already borrowed from other organizations and people? And there's good theoretical basis for why that should be important, because if I calculate my debt to income ratio, the more debt that I have relative to my income, the more committed I am already, the more difficult it will be for me to take on more commitment, debt commitment. So there's a good theoretical basis for why that should be important. And in many cases, it is important. However, in many cases, it actually isn't important at all. And we're able to test models by including a debt to income ratio and then building the same model and leaving the debt to income ratio out. And we'll find that in many cases will actually make no difference to the predictive power of the model. That's a bit counterintuitive. I would have expected on a theoretical basis for debt to income ratio always to be very predictive of a person's credit performance. But many cases we find that that's not the case. Conversely, after building many credit scorecards, what we often find almost universally is very predictive of a person's credit score or credit worthiness, even over very long-term debt, like 20, 30-year mortgages, is the day and time that a person applies for credit. And the only reason I know, which is very counterintuitive, to this day, I cannot tell you why that's the case, but I can tell you that after building many hundreds of these credit scorecards, that almost universally ends up being predictive. And the only reason I know this is because I didn't impose my prejudice on what ought to be predictive and what ought not to be predictive on the machine. I just gave the machine all the data and let it build its model, and let it for itself decide as autonomously as possible which variables are going to be useful and predictive and which ones aren't. And one of the ways we do this is working out how predictive a variable is by building one of these feature importance tables. And the way we do it is we often, let's say we have 100,000 loans that we've given out before, or 100,000 insurance policies. So let's say we've got that. And I know how they performed in the past. So let's say I train my model on, say, 60,000 of them, and then I hold 40,000 of them back to see how well my model's working. So I'd get my machine to make predictions about either the insurance risk or the credit risk or whatever the risk is of the remaining 40,000 lines of data. So in that case over there, I can work out how well the machine did, and I'll get an error rate. As I mentioned, no machine learning model is going to be perfect. They're almost always going to make mistakes. So I can measure how right or how wrong that machine is, and I can measure the error rate. So what we do in order to test how important a variable is we build the model sequentially lots and lots of times, but each time we leave out a single variable. And if the variable is not important, then when I leave it out, it will make very little, if any, difference to the error rate that the machine was getting on the test set, because I actually don't need it. But if the variable is very important and very predictive, then when I leave that variable out of the model, I'll suddenly see my error rate jump and increase by a large amount. And obviously, between the biggest and the smallest, there's a whole spectrum in between. So what we do is we can test every single one of the variables that we put into our machine learning model, and we can actually then test how important each one of these things is to the actual feature that I'm interested in, whether it's default or whether it's insurance risk. And so what you're seeing over here is one that we did, and it was actually done for a credit scorecard. And what you'll see over here is that there are three things that actually were very interesting to us on this particular credit scorecard. What we found was that this particular variable, which was the 6-month average on government bond yields, was actually near the top of the most predictive variables. Also interesting over there was the 6-month average crude oil price. And also interesting to us over here was the level of the index on the stock market that dealt with construction companies. Now, this over here wasn't something that we necessarily would have thought of. In retrospect, once this was brought to our attention, it made a lot of sense, because the particular segment of the market that this particular financial institution dealt with was in heavy construction, where the amount of contracts that they receive is obviously reflected in their stock market prices. And these are people who use a lot of money, who use a lot of oil in their operations to operate heavy machinery. So that's one of their major costs. And these are also people where their customers are able to buy and sell their services, is very dependent on the interest rate that's available in the market. These all make sense in retrospect, but they were things that originally were considered in the machine learning model, at least in their scorecard. And it was only once we threw all the data that we had available and that we thought might be useful into the model that we saw that, in fact, these things were not only predictive, but in fact amongst the most predictive variables that they were in the model. And so what this now allowed this financial institution to do is actually modify and moderate their lending based on the performance of these particular metrics, which they weren't even watching before. And so they now know that they're very much vulnerable to interest rates. They know that they're very vulnerable to the price of crude oil, and they also know that they're very vulnerable to the amount of contracts that are happening in the market and the level of the construction index. And these are things that they now watch a lot more actively. Again, in retrospect, very obvious, but it wasn't obvious in the several years up to the use of machine learning. So this was a way for them to discover that variables were predictive and that they in fact were exposed to risk in a number of different areas which they'd never thought about before. Now, I do want to point out over here, whether you're using a traditional methodology for credit scoring like a logistic regression, or whether you're looking at these variables in a more sophisticated machine learning model, the fact that a variable is predictive doesn't mean that that's what causes it. So we often have the problem of correlation, of spurious correlation. The fact that two things are correlated doesn't mean that one causes the other. And I'll give you one of the best examples of this I ever came across is that if you take a look, there's a very high correlation between the score a person would get on a standardized university mathematics exam and their shoe size. Believe it or not, I'm not even making this up. The correlation is in the 90s. The correlation is in the 90s between shoe size and how well a person does on a standardized university mathematics exam. And the reason this makes sense, though, so you might say, well, people think with their feet and their brains are in their feet, but the reason this correlation is true is because they tested this across the entire population, and first graders, second graders, and people in primary school tend to have small feet and they don't do well on university maths exams, whereas people at university tend to be older and have bigger feet. And so they tend to do better on university maths exams. So in fact, over there, it's not that people think with their feet. It's just that shoe size, it tends to be a good predictor of how many years you've spent in school and studying. And that's actually what your performance on university maths exams is correlated to, not your shoe size. So the point that I want to make is that you've got to be careful about spurious correlations, things where you see that variable A is correlated to the thing that you're interested in, whereas it might just be masking some other feature which is really much more important. And so you'll often find that in built-in insurance pricing engines or sales propensity engines and that type of thing, that you'll find that they say males or females might buy this product more or less. Sorry, there's so before I get there, I see that somebody asked, according to how did you determine the value of the kind of risk? I think, I'm not sure. I'm not sure if I've already answered that, but in essence, what we were saying over there was that we worked out how predictive this was. We worked out the impact that each of the variables made on the error. So we worked out the error rate by having all the variables in, and then we ran the models again, successively leaving one variable out at a time. And when we saw that we measured how much bigger the error got when we left a variable out, and then we compared the increase in error when we left a variable out to each other to come up with this number system over here. So this over here was just actually scaling them these percentages are really just expressing what percentage of the total error is explained by these variables. That's what we did over here. But there are a number of ways to do this. You could actually just keep it in absolute error terms and then see how they compare to each other. But that's how we worked out their relative value, or their value relative to each other, is just by seeing for each one of them, comparing how much bigger the error got when we left that variable out. So I hope that answers the question. So coming back to this, you'll often find that in building particular models, whether it's sales or credit or insurance, you'll find that a variable ends up being very predictive in that model, but the fact that a variable is predictive in that model doesn't tell you why it's predictive. So you might find that males buy this product more or females buy this product more. That doesn't, so you might see that it's very much dependent on gender. It doesn't tell you why it's dependent on gender. It might be something obvious. Well, females buy this product more because they're dresses. But if we're talking about stuff like plane tickets or insurance products or cars, it doesn't tell you, knowing that females buy this product more doesn't tell you why they buy that product more. The car wasn't specifically, or the product wasn't specifically designed for females. So you'd have to do more digging. You'll have to do more digging to get that, to explain why gender is actually predictive of why somebody's more interested or less interested in a product. Somebody just asked me to repeat the correlation example. It's just that we showed that there's a very high correlation between a person's shoe size and their score on a standardized maths test. And that was in fact because first graders and primary school students don't do so well, who have small feet, don't do so well on university maths tests, whereas people who are at university, who have been at school for many years, tend to have bigger feet and they tend to do better on university exams. So the message from there was that we shouldn't learn that people think with their feet or their brains are in their feet. We should learn that, in fact, actually, it's a marker for something else, which we should actually try and measure directly if we can. So that's the first thing. So in the step of identifying risk, we can see over here that machine learning can be very effective at identifying new types of risks that we might not have thought of. We've just got to make the effort to present as much data to the algorithm as we can and see what actually pops out of the data. In the next part, we talk about analyzing, quantifying, or integrating risk. And one of the things that we mentioned over here is we want to take a look at how important particular factors are, not on their own, but in the context of everything else. Now, if you were to actually just say, in this particular case over here, this is a credit scorecard, so we're looking at default rate. And what we could actually do, if we thought that there was a relationship between the age of a business and default rate, is we could actually just take a look, first of all, just directly analyze the correlation between default rate and age of a business. We could definitely do that. And we might even go so far as to build a linear or a logistic regression model that would directly map default rate onto default rate from the age of a business. We could do that. However, what we want to see over here is not how important the age of the business is on its own, but how important it is in context. And believe it or not, this graph that you're seeing over here was actually derived from this particular model that I showed you a few minutes ago. And what we did over there was we have the age of the business as one of these variables. We have it down as actually as a registration number, but you can see over there, sorry, company age is in fact the second biggest number, the second biggest, most important variable in this particular credit scorecard. And what we did over here was, but what's the advantage of looking at it over here is that we've now got a model that considers many, many variables. In fact, over here, I should actually mention that these are just the headline variables. Each of these variables is in turn broken down into many sub-variables. So this is part of many, many variables, and all of these variables together in this particular model are being used to predict the probability of default. So what we did over here was we then took all of these variables and we put in a bunch of existing loans as they existed on the book, and it had all of these variables for each of the loans. And then what we did was we took the company age and we adjusted it up a year or two and then down a year or two for loans that we had, and we saw what difference that made to the predicted default rate. to the predicted default rate based on making companies a year or two older. And what we find with that is that you now end up with a relationship between default rate and age of a business, but it's looked at in context with all of the other variables together. So it's not looking at default rate on its own. It's looking at how important default rate. It's not just looking at the age of the business on its own. It's looking at age of the business and its impact on default rate within the context of considering many other variables. And what you're seeing from here is that we see that, at least at the beginning, for particularly young companies, they have the highest default rate. So you see over here, this case, it was over 14%. You get a substantial drop off going to businesses that are between 10 and 20 years old, and even more so when you get to ones that are between 20 and 30 years old. But in fact, there's almost no difference between those two over there. So what you're able to get using these models is, first of all, an assessment. There are two things that you get out of using a complex machine learning model that you wouldn't have gotten necessarily out of a linear regression or a logistic regression. The one thing is that you get to see how that particular variable impacts the thing that you're interested in. In this case over here, default rate, you get to see how that variable works in context overall with all the other variables. If you just plotted it on its own or fit a model on its own between age of the business and default, you might have got a skewed view and towards an overly important view of how important that particular variable is. Whereas now that we're actually testing that variable in combination with all the others, we get a very different view where we see in context it is important, but it might not be as important as the impression we would have got had we only modeled default rate on age of the business on its own. And the other thing that what major advantage you get from using more complex models is that in fact you don't need to have straight lines. So what you'll see over here is that this over here actually, as I go backwards, it's almost like a J curve in the sense that it drops quite precipitously for a while and then it flattens out. So I can actually end up with very much more complex relationships than just straight lines. You'll see over here that the straight line, which I plot over here, it underestimates default rate on that because it doesn't come to the top of it. It overestimates in the middle, and again, it underestimates over there. Whereas if I'm able to fit a line, I can actually make it match these exactly and give me a much more accurate view of the actual default rates that I expect based on the age of the company. So the advantage of these machine learning models incorporating all of the variables that actually end up impacting the feature that you're modeling allows you to do this integration step by testing by being able to establish the distribution of your risk in combination with all the variables together. So this is the second part. This is actually step 3 of the 7 stages that I mentioned before. You might do this over here. Another way you might have seen these graphs represented is where we work out the feature importance. This is a medical example over here where this over here stands for something about nitrogen in the blood. And this over here was working out variables that we can use to predict the likelihood of kidney failure. And you'll see over here, the amount of dissolved nitrogen in the blood, in this case, was the most important predictor. And then glucose and hematocrit and all of these types of things. But these over here are things that allow you to assess the importance of these variables in combination once again. And then the last thing that I wanted to mention is that in combination, what you might want to do is actually take plots of how variable the feature that you're interested in how variable it is relative to each of your variables on their own. This is the type of thing that happens most commonly. So in this particular case, I'm modeling something called Y, and it depends on 4 variables called Z1, Z2, Z3, and Z4. And what you're seeing over here is that if I look at Z1, it's relatively circular and it's relatively tightly packed, which means that actually Z1, when I see that type of feature, it means that it's actually not that dependent on Z1, because no matter what I do to Z1, it doesn't change by much. It's of the 4 graphs, the most tightly packed, and also doesn't have any particular shape, which means whether I go up, down, left, right, it actually doesn't make much of a difference because it doesn't make much of a difference, which is why it's uniformly shaped. But going down to the bottom corner, when I've got Z4, you'll see that this is a variable which is very important in predicting Y. And the way I know that is because it's very spread out. And because it's very spread out, it means that changes in Z4 will make a difference to Y. So it will make a big difference to Y, which is why I'm getting such a big spread out. And also it spreads out in a specific direction. So you'll see over here that moving up and down doesn't tend to make much of a difference, because the actual variation in the up-down direction makes very little difference. But the variation in the side to side, from left to right, that makes a huge spread. And so I can then know that in that Z4 dimension, that Z4 is very important, but I also know how Z4 needs to vary in order for it to impact Y. So these are things which, again, different ways of me analyzing my data to make sure that I can see how my data varies, but in aggregation with all of my variables together, depending on the variability of specific variables in my model. I can pick and choose them and see what impact they make, but specifically when they're built together as part of a model and not when they're done on their own. Another thing that's also very important to do over here, often in big data sets, is you'll have many variables that are correlated to each other, and that can actually give you a very warped view of how important specific variables are. And the part of the reason for that is that you're actually you'll find that each of these variables on their own, when you test them, are very important, but they don't actually add that much value to your model. So I'll give you a good example. In medical science, there are many, many studies that relate to causes of heart attack. So there are many studies that show that smoking is very highly correlated with the person having a heart attack. Obesity is very highly correlated with the person having a heart attack. High cholesterol is very correlated, or a high fat diet is very correlated with the person having a heart attack. So all of these things work nicely. But what happens if somebody comes into the emergency room, that person is a smoker, is overweight, and has a high-fat diet? Does that mean they're 3 times as likely to have a heart attack than if only one of those things was present, or are they 50% more likely? So the point is that actually, as it turns out, those variables are highly correlated, and in order to get an accurate view of how each one of them works, you actually need to remove the correlated variables if you're at all able to. In order to be able to work out effectively how important each of the variables are. I see that Mona has raised her hand. Mona, are you able to type your question rather, if that's okay? Or would you like to keep your question? Yeah.
Yeah, Mona, if you could please, if you have a question, could you please put it in the chat box? I will now lower your hand, because we often have the case that someone accidentally raises the hand.
Okay, sure.
But
Perfect.
if you want to say something, Mona, please use the chat box if you manage to use it. Otherwise, you can also write us an email later.
And also, I'll be stopping in a few minutes for questions. So we're almost there. We're almost there. So. And then finally, when we talk about integrating risk and modeling complex systems, the reality is that one of the things that's amazing about machine learning is its ability to handle complexity. And many times what we do is we actually model things badly because we're humans and we're quite simple, and we try to break things down into their components and model those things separately. And really, in many cases, we end up with a very wrong view just because we don't model it all together. So I'm going to show you over here a typical insurance company. For an insurance company to make money, it's got to sell stuff. It's got to assess the risk properly to make sure that it's not just selling policies to people who will claim. You not only do you now have to sell and vet the risk properly, but you actually need to get premiums paid to you. And then finally, what you need to do is actually need to make sure that you don't have these claims. So now often what happens is that these things work against each other. So when it comes to selling, people who want insurance the most desperately, in many cases, tend to be the people with the worst risk. And so on their own, you might find that the sales model says that this is the list of people who you should try sell to because they're most interested. But those exact same people might get declined on being too risky. And even if you sell that, there's no guarantee that the person will pay their premium. One of the biggest problems in insurance is selling policies where people don't pay their premium properly. And in fact, the business never ends up recovering the cost that it incurred in selling the policy in the first place, initial commissions and so on. So you could actually build models that model each of these things separately, and this is commonly done. One of the things that is so exciting about machine learning is that you can do the entire process end to end. So you could start off with a list of leads, and in one step you can actually get a machine learning model to model the entire process and say, from these leads, can you pick out for me the people who are interested in my product, who are not too risky, who will actually pay my premium for a year or two, and who won't claim? Can you choose for me those particular people out of the entire list? And you can get the machine to do that in one go. And the truth is, we do this type of thing all the time. One of the examples I always like giving if I were to tell you there's a half price special on plane tickets to London for next week, which of your friends would be interested? If you just think about that for a second, immediately in your head, you might have one or two friends who spring to mind who might be possible, but the overwhelming majority of your friends probably not interested. And that's valuable information too. But implicit in choosing those one or two people, you've worked out which of your friends you know would like to go to London, who can afford to go to London, who is spontaneous enough to undertake an overseas trip on short notice, who has the flexibility of schedule to do that. You did all of that implicitly in one step and without even thinking about it outright. And we can get machines to do the same thing by modeling entire processes in one go. So when we want to, so instead of modeling sales, we could actually model profitability or profitable sales, which would incorporate all of these things. Another advantage of the machine learning system, where we can actually compress and deal with multiple risks all at the same time, as well as the interaction of those risks with each other. Another major advantage of building these machine learning models. Sorry, I see that there's a question. It says, when it comes to auditing and reviewing risk functions, post-fact review would always have its flavor. Using AI and ML indeed will reduce the paperwork being moved to the data analysis instead. My question is how to build up such environments among non-digital oriented ones. Being hiring staff to do the process will be challenging in a now COVID-19 circumstances. Appreciate your advice. So what you're talking about is a major issue, because in many cases we can automate this process. I think the question being asked is how can you get people to start using machine learning when it's really such a new thing and people aren't accustomed to it, especially during COVID-19. And it is a major problem, because people are used to doing things in a particular way, and machine learning is very new for a lot of people. And also part of the problem is that it can be very humbling. And when I say it can be very humbling, is we're all very used to the idea that machines can do things physically that we can't do. So we're happy with the idea that a machine can pick up something heavy or move something quickly much faster or effectively than a human could do. But we're actually at the point where machines humble us in the sense that they're able to recognize patterns that we as humans are unable to recognize. And especially when you're dealing with people who have been experts in a particular field, it's particularly humbling. And I include myself, by the way. It's particularly humbling when a machine can outperform you at a job that you've spent years training to do. And so part of the way we do this is by showing people the benefits of it, but it requires education. It requires a lot of time and care. You're taking people along for a ride over here and showing them that actually it's a very powerful tool that they can make use of, just like a builder can use a crane to pick up something heavy. This is something that we can actually now use in whatever field we happen to be to help manage our risk. And it requires quite a lot of cultural change. And it's also not the type of thing that you should have the expectation that it's going to happen overnight. It's really going to take time and education and building trust, because it's not something that many people have experience with. Okay. Okay, perfect. So, but if I haven't answered your question properly, please raise it again in the question section. And another way over here where we can actually treat, so if we move on to the next stage over here of the risk management process, when we talk about treating our particular system, machine learning can be useful for that too. And what you're seeing over here is actually a credit scoring model. And I need to put out in advance that this graph is a lie. And I'll tell you why it's a lie in a second. The reason it's a lie is because we had a financial institution that was lending money to its clients, and it was using best of breed traditional credit scoring methodologies. However, the problem was is that they were losing money hand over fist. They really didn't realize how much money they were losing. So this 100 over here, which was how well the company was doing, was in fact minus 254 million rand. It was South African rand, but because they thought they were making lots of money at the time, I had to rebase everything. So I started them off as at 100, but in fact, every number that you see over here is 354 million rand higher than it really was in real life. And so what we did over here was we built a machine learning model to take into account the various to take into account a much broader set of data and to deal with all of the variables plus their interactions together. And what we're able to do over here was actually turn a portfolio of business that was very much loss-making into money, into something which was 369 million rand, which again, if you subtract 354 million, is only about 14 or 15 million rand difference. But making 14 or 15 million rand is way better than losing 254 million rand. So it was a substantial increase in what in what they're actually doing. And this is a case over here where we can actually replace many of the traditional modeling methodologies with machine learning models to do substantially better. So in the insurance space, where the actuarial profession has been there for 300 or 400 years, this is actually one of the major areas where we're finding that a very well-established, very technical and very mathematically literate industry is being changed dramatically by the use of new methodologies, which are able to see patterns which we haven't been able to recognize before. The one thing that I wanted to talk about over here, and I've been hinting at it, is that all of these cases over here have so far been about managing risk in terms of avoiding it or treating it or doing something else with it. But in many cases, you can actually exploit it to your advantage and make the business much more profitable. So this again is a credit scorecard, what you're seeing on the screen. And what this was able to do was, so historically, this particular institution had a manual credit approval process. They had a credit committee where businesses would come to them and apply for credit, and they would get financial statements for each of these businesses, and the credit committee would read through these financial statements, analyze the businesses, and come up with their decision, which took a lot of time. And also they were just by nature very conservative people, and so they declined a lot of business. So what we did is we replaced it with a machine learning based credit scorecard. And what we found over here is that, first of all, the machine rejected 11.5%. That's the third block, the first white block. The machine rejected 11.5% of the deals, or would have rejected 11.5% of the deals that they had done before, which obviously is not something that they enjoyed, because that's less business, and this bank made money by lending out money. But what we also found was that in the business that they had declined, which was 6,621 loans had applied and hadn't gotten approved, we actually found that the machine learning model would happily have approved 2,600 of them. So what we found was that actually that if you added everything together, if you subtracted the sales lost, which was 555, that was an 11.5% drop in sales. But because the machine was more accurately able to determine risk, it actually ended up approving more loans. So what we found over here is that this machine learning model, and it was actually deployed into practice and ended up working like this, we found that the bank ended up having both things go its way. It was able to be much more accurate in terms of its credit policy and had a much lower default rate, but it also ended up getting more business. So by handling their risk better, by managing their risk better, they were able to have their cake and eat it. They had lower default rates, plus they were selling more business, whereas normally with blunt tools, you have to choose one or the other. You can either have better credit or you can have more sales, but you can't have both. Whereas if you're able to do things more accurately, you can actually do both. You can have more business with better credit risk. Another example of this, and I think this might actually be my last slide, is Lemonade, who I don't know if you've heard of, but they've become quite famous. They're a totally online, at least when I say online, mobile insurance company. They started 4 or 5 years ago, and they do everything on your phone. You sign up on your phone, you manage your policy on your phone, you claim on your phone. So a few years ago, they made a real splash because they set a world record for paying a claim. And what happened was there was a guy who had a very fancy jacket was a $1,500 jacket that he had lost, and he claimed, so he filled out the claim form on his phone, and from the moment he hit submit on his phone to the moment he got a text from the bank saying that the money was in his account was 3 seconds. So as it turns out, they don't do all their claims. You can see that on their website. They say it's an average of 3 minutes to get paid, but they paid one claim in 3 seconds, and they got a huge amount of publicity out of that. So how did they pay a claim in 3 seconds? So in that 3 seconds, the person's details went through 19 different machine learning algorithms to, first of all, test, is this person a valid policy holder? Does this claim look like a real claim? Is it fraudulent? Does this look like the profile of a fraudulent claim? And all of these types of things. Are his bank details correct? It went through all of that. Now, they at the time were only paying less than 5% of their claims in an automated way like that, which means that only a very small fraction of their claims were being settled like that. But the thing is that they made such a splash about that, was that not only did they end up in, by the way, they do much more at the moment. So not only did they end up reducing by a huge margin their claims fraud, but they made such a PR splash about that that they ended up signing a huge amount of business. So they have reduced underwriting costs because a lot of their claims underwriting is being done by machine learning algorithms instead of by expensive people. The actual claim time and cost is reduced, so they're approving claims much more quickly, which leads to much better customer experience. People love this type of thing. Amazing PR. They were in every single online newspaper and periodical that you can imagine. But also because of this, they got a disproportionate amount of new business. So in their first year of operation in California, they got a quarter of total new business in the state of California just because they had this customer experience. So not only did they reduce their fraud and reduce their costs, but they also signed a ton of new business because they exploited this particular aspect of risk that they were dealing with. So another huge opportunity that we have over here in order to get things better and actually exploit our risks by doing things well. And they ended up with better claims ratios too. So just a few words of advice. Yes.
Yeah. Before you come to the last 5 minutes of your slides, let me just announce that I shared the link for your attendance. Please click on the link and leave your information here. I will now paste it again in the chat. So please click on the link, register, and you will have the training material once you registered, and will also know that you attended this session. Okay, Danny,
Perfect.
Go ahead.
I'll do this. I'll try to do the slide in 2 minutes that we can leave a few minutes for questions. But a few things that we need to deal with, and I think this was a question that was asked a few minutes ago. AI, as wonderful as it is, and again, you're not going to get anybody to believe in AI as much as me, but it's wonderful, but many people find it threatening. So if you want to practically take advantage of AI, you need to get people's buy-in. You need to take them along for the ride, to show them how it works, to explain it, to show them the benefits that they can have, to give them a chance to kick the tires and feel for themselves how it will work. And it's got to earn their trust. And if you try to impose AI on an organization, it is almost certain to fail because nobody will use it. Another thing that you need to do is document the entire process. And even if people can't explain the machine learning model, which is in many cases is the situation, it's very competent for people to know what the machine is doing. As you've seen over here, the machine isn't doing anything fancy. It's busy chopping squares into smaller rectangles or trying to combine variables together. It's not doing anything fancy. It just looks mysterious because it ends up being done at scale. But it's comforting for people to know the mechanics behind it, even if it's at a kind of bird's eye view. It does give people some comfort for that. Another thing over here is that it's very important that when you're presenting this to people, that you translate it into things that affect them. So you'll often, if you've worked with machine learning, you'll hear people talk about their mean absolute error or their root mean square error or their Gini coefficient. Nobody knows what that means, and it scares people. So what you want to be able to do is translate your model into a business outcome. So you might translate it into, this gives you this many more sales. This increases your profit by X%. This reduces your costs by X% or X fraction. if you can, it's important that you take the time to translate the outcomes of these machine learning models into stuff that people understand, because if you don't translate it, it's not even clear that you're adding value. To yourself, you might not even be clear. And the other thing which has become a big topic is the use of ethics, because unfortunately, many times the company might be happy with the use of a particular type of AI, but customers might not be. And so we had a very particular disturbing situation where a company was signed up people as a bank, and then they got sold to a health insurance company. And then we had the opposite, where a health insurance company got sold to a bank, and people were contributing a lot of sensitive health information, which they did for their health insurance, but now the bank was using these particular variables to try sell them financial products and who knows what else. And the customers rebelled and they lost a huge amount of business. And in many cases, what you also have to watch out for is unintended discrimination. And you could end up with very, very unsightly and inappropriate outcomes. So in South Africa, actually, there was a bank that got sued because it was found that for Black applicants for mortgages, Black applicants had a higher decline rate, and when they did get approved, they were being charged a higher interest rate, which obviously in South Africa was unacceptable. As it turns out, it's not that they discriminated on the basis of race, they discriminated on income, which happened to be a very good map or proxy variable for race. And even though they didn't set out to achieve this, that's what they ended up with, and it was incredibly bad for them and in the market. And I don't think if they were in the same situation, they would have done it again. And the other thing that you need to take into account is that we're all still learning about this. So when you come to do machine learning, it's important that you set aside budget, both in terms of time and in terms of resources, for experimentation. It is very unlikely that the first thing that you produce will be the final thing that you want to deploy. And so you need to budget for experimentation and iteration. With that, you'll hopefully end up with something that's useful. Not to say, by the way, that you need to wait till you've got the perfect model to deploy. You might deploy with something which is, say, 60% of the way there and keep on updating it over time as you continue to experiment. But don't expect your first model to be perfect and super valuable. So I think that's all I wanted to talk. Sorry, it's not the last. And the last thing is that people forget that AI only produces information. It doesn't change anything. So you need to take into account the non-AI as well as the human components of the process. So we built a model that predicted which bank account holders were going to close their bank accounts within the next 3 months. It was very accurate, but knowing who's going to cancel their accounts doesn't get them to not cancel their accounts. There needs to be an additional process which the machine learning doesn't actually do, which you need to build on if you actually want to get value out of machine learning. So I'm going to stop here, and thank you for your time. And I'm very happy to take questions at the moment, if anybody's got. So I'm just going to take a look at the chat.
Thank you, Danny. Yeah, please take a look if you can see any questions that you haven't answered. I know that you have answered quite a lot already. There were 2 questions about the certificate. So if you attended 5 webinars and you registered each time in the attendance sheet online, then yes, you will receive your certificate, of course. We are now going through all the attendance sheets this week, and then later in the month, we will get back to you with the certificate.
Okay, thank you, everyone. By the way, if anybody's got any questions, my email address is on the screen. I'm more than happy to answer questions if you'd like to write to me directly. Yeah, so if you've got any questions now, that would be wonderful. Doesn't look like there are.
Yeah, the ones that are in the chat you've already answered, so I will take them out. Okay, I think if there are no more questions, I mean, either way, you can get in touch with us by email. I'm now sending again the link to the attendance sheet. The recording will be uploaded later today. So tomorrow you will see the recording. Someone is asking me if I'm outdoors. This background is not real. It's not the real background. Let me show you how it really looks. Oh, I'm indoors. Okay, it was great to have you in our series, in our webinar series. I'm sure I will meet you all again in one form or the other. Danny, I'm sorry, I'm going to take a 1 minute to say a proper goodbye because this is, I've been following the session from the beginning. And it was a pleasure for me, very interesting. Uh, Nice to have you. If you have any more questions on the content of today or in general on Frankfurt School, on risk management, on any of the topics that we discussed, please get in touch with us. I'm now sharing again the link to our website, and there you will also see our contact details. And thank you so much, Danny. Very
Thank you.
interesting session. A lot of content in a very short time, so very useful, I think, for all of us. And I'm sure many of us will watch the recording again and go through the concepts again. Thank you so
Thank
much,
you.
Danny.
Thank you, Celia, and thank you everyone for joining me today.
Okay, have a great week, everyone. Goodbye.
Take care. Bye.